So that one. Sorry, let's start at the front. Okay, so financial mastery. Well, it's curious, isn't it? Because a lot of business owners do have a great relationship with money, but actually not everybody has a great relationship with money. Some business owners are really good at controlling money, planning money, forecasting money, making money, whereas others tend to have a slightly different approach, at least initially, by working as hard as they can and then looking back and say, hey, did we make any money? But if you think about it, that's like flying a plane without any controls or without any clear view of what your destination is, which is pretty dangerous. So what I hope to cover today is three things. First of all, at the end of this session, you should know how to control your finances. Secondly, at the end of this session, you should know how to build a clear financial strategy for you and your business. And at the end of this session, you should know how to build profit through focusing your precious time on the key profit drivers. So those are three outcomes I want to achieve today. So the first bit is knowing how to control your finances. So let's go back to the plane analogy. What are the dials that you have on your dashboard? Now, for those of you that are experienced business owners and have a great relationship with money, this might appear pretty basic, but I have no apologies for sharing it because it's really important. So what are our key controls? Well, the first one is our profit and loss account. So this is our scorecard. So, if you gamify business to make it fun, this is the scorecard. And it shows us our performance for last month and previous months. So it shows us the trend in our performance. Now, a lot of business owners leave it for 2 or 3 months before they look at their profit and loss. And I'm going to encourage you to close off your profit and loss account by the 10th day of the following month. So then you can see real information. And why that's important, because it allows you to make in-time objective decisions about the business you're running today. Now, obviously, the profit and loss account is, in theory, pretty simplistic. It tells you the sales that you did, minus the direct cost, which gives you your gross profit, minus your overheads, gives you your net profit, minus this tax thing we have to pay to give you your net profit after tax, which in effect, as a business owner, is your money. That's where you take your dividends out of. So the scorecard is pretty important from that perspective. Now, another number I like business owners to really understand and know off by heart is what their break-even sales is out of their profit and loss account. So to calculate your break-even sales, which is the point at which you start making money, you just take your overheads and divide it by your gross profits percentage. And that tells you where your break-even sales is. So above that level, you're making money. Below that level, you're losing money. So a quick example, let's say your overheads were £15,000 a month and your gross profit percentage was 40%. Your monthly break-even is 37,500. So when you get to that point in the month, you're safe. Above that, you're making money. So that's a really important number for all business owners to know. So that's the first control that I hope and expect everyone to have in place. But actually, the next one is probably even more important, which is your profit and loss budget and forecast. Because this is your goal. This is your financial goal. It's a route map you're following to get to a better place. And I know most of you on this call are growing your businesses. So this is the bit where you plan how you're going to grow your business, what your sales want to look like, what your margins want to look like, and what are the strategies that are going to help you get there. So clearly, this is a real key one. Now, what I encourage everyone to do is when we close our accounts every month, then check the actuals versus the budget and update your financial forecast. Now, your budget, let's call it the plan, that is fixed for the year. So we're going to compare our actual numbers every month against what we plan to do. And obviously, if there's a difference, the key question for us is why? Why is there a difference? And the forecast is where our running total is. So that's where we are planning now, or where we think we're going to end up at the end of the year. Now, obviously, if our forecast is showing that we've got a deficit in our budget, we need to take some actions to correct that. Whereas if it's showing that we're above our budget, then we're in good shape. So this P&L budget and forecast is probably the most critical document to set the course that you're going to go on. But there are a few other controls as well, which are equally important. And the next one is your cash flow forecast, because cash is not equal to profit. It's very different. A lot of businesses we see all the time are very profitable, but they don't necessarily all the time have enough cash. And frankly, any businesses that fail, they don't fail because they're not profitable. They fail because they run out of cash. So once you've got a profit and loss forecast, you can then do your cash flow forecast to see if you've got enough fuel in the tank. Now, as you're growing businesses, it's not a problem to be forecasting a negative cash flow, because sometimes we need to put more fuel in the tank in order to grow faster. But as a business owner, we need to forecast when we need that money, and more importantly, how we're going to get it. So when do we have to raise debt or equity to fund growth for the future? So your cash flow forecast tells you that. And I encourage you to be at least 6 months in advance or even 12 months in advance on your cash flow forecast, so you can see that that tank has got enough fuel in it to fuel your growth. So that's the cash flow forecast. The next statement is the balance sheet that you should be aware of as well. And that is a statement of your financial health. It tells you what assets that you own and what liabilities that you have. So in simple terms, you've got assets which are categorized as fixed assets and current assets. So fixed assets tend to be things like machinery, buildings, computers, all of those type of things that depreciate. And current assets are things like cash and debtors, mainly debtors. That's people who owe you money. And on the other side of the balance, we have liabilities. So your current liabilities are your creditors. Your creditors, people who you owe money to, and also your long-term liabilities. So that's any debt you have on the balance sheet, any loans that you have that need repaid. And obviously the difference between your total assets and your total liabilities is what you owe. It's your equity, is the difference between those two. Now, having a healthy balance sheet is really important, particularly if you want to borrow money. So if you want to borrow money to fuel the growth of your business, then the first thing that a bank or a lending institution or even an investor will look at is they'll have a look at your balance sheet. So you should understand your balance sheet and make sure it's in a healthy position. And the last two tools we use to navigate our way through along our financial journey are the marketing dashboard and the pipeline report. So the marketing dashboard basically tells you how healthy the lead flow of new customers is coming to your business. Now, if you ever come to sell your business, this is a key part of the value of the business, because if you can demonstrate that you've got a marketing machine that brings new leads into the business at a decent cost per lead, then that has a huge amount of value. So understanding your marketing dashboard has real financial value to you. So it's a key document. And also your pipeline report. So your pipeline report is all of the predicted sales you got over, let's say, the next year. So that's the amount of sales that are going to flow through your business over the next 6 and 12 months. And clearly that can be monetized. So we need to know how much business is coming through, because we need to plan our resources and our cash to make sure we can satisfy that business that's coming through our business. Now, if you put all that together, then you can visualize our cockpit in our jumbo jet. And these are the things we're going to look at. We're going to look at, okay, do we have enough leads coming into our business? Are they consistent at the right price? Do we have enough sales to meet our P&L and budget forecast? Is our P&L behaving like we thought it was? Are we making the profit that we budgeted? Are we on track to meet our financial goals? Do we have the funding we need in order to fuel our growth? And is our balance sheet in good shape so we're building the assets of our business? So for those of you who are super familiar with this already, I apologize for going over it again, but I think a lot of people that we deal with tend to understand these things, but it's a different thing to understand them and actually do them. So now, as a business owner, you don't have to do them yourself, but what you do need to do is know how to read them and know how to make good decisions based off the objective data that these reports give you. So that's about controlling finance, controlling your money. I now want to go on and talk about strategy. So, and I asked the question, what is your financial strategy? Because in business, there's probably only 3 real ones. And we talk to a lot of business owners all the time, and this is what we hear all the time. So the first one is I want to go into business because I don't want to have a boss and I want the independence. So effectively, you've got a job, but without a boss. The second one is to use the business to build an asset that can yield passive income for you in the long term. So it's a business which is an asset that you don't have to be involved with in the long term, but is providing you a constant stream of dividend income. And the third strategy is to build the business as an asset that you can sell. Sell it for enough money to be able to invest, and those investments will give you enough passive income for the rest of your life. So those are the 3 strategies. Now, all of these are perfectly okay as strategies, and we hear all of them all the time. The first one, though, I'd say, look, if that's what you want to do, if you really love doing what you do in the business rather than working on the business, that's absolutely fine. But I'd encourage you, if that's your strategy, to make sure you're investing any excess income into other forms of investments like pensions and property and that type of thing. So when you get old and you don't want to do the work anymore, or you just fall out of love with doing the work anymore, well, at least you've built up a passive income through other investments. So that's probably what we need to do on strategy number 1. So let's turn our attention to strategy number 2, is how do you build an asset that yields a passive income? Well, what I encourage you to do here is actually set a goal. So, okay, well, how big would my business have to be? And what role would I have to take for that to be true? So let me give you an example here. And at the end of the session, by the way, I'm going to ask you a question. So think about the answers to your question as we go through. So the question is going to be, do you have a clear financial strategy? And are you on track to achieve it? So think about that whilst we're going through the next few slides. Okay, so let's take the build to hold scenario. So this is building an asset that gives you passive income. So let's say, for instance, your passive income target was 150,000 a year before tax. So basically, you want a business which you don't have to be involved with too much, but pays you every year an annual dividend of 150K a year. Now, if that's going to be true, that means the net profit of the business after tax should probably be more than that, because you're probably going to have to reinvest some money back into the business every year. So let's assume that if we want to earn 150K, we need to be producing an annual net profit of 200K. In that case, our net profit before tax, assuming that we have to pay 20% corporation tax, I know that's going up, but today it's 20%, then our net profit before tax would have to be 20% more than the 200, i.e. £240,000. And let's assume our business was structured in a way that delivered a net profit margin of 20%. In that case, we'd have to build a business with an annual sales of 240,000 divided by 20%, so a 1.2 million pound business. So if you could build, as a business owner, a 1.2 million pound business with a 20% net margin, run by an independent team, then you've got yourself an asset that'll give you enough passive income for the rest of your life. Now, the only caveat to that, the sense check, is make sure that you can build it with a self-sufficient team so you don't have to be involved in the day-to-day operations. Because you know what we're trying to do is create money and time to enjoy it. Because money by itself ain't a lot of fun unless you've got time to enjoy it. So make sure you build your organizational structure from day one with the end in mind. So you manage yourself out of the day-to-day operations of the business. So that's an example of you setting yourself targets on the build to hold strategy. So let's go and talk about the build to sell strategy. So before we do that, we probably just go over some principles about how a business is sold, familiar to most of you, but the most common valuation method for a business is the price is calculated on the EBITDA, which is a form of profit, times a multiple of EBITDA. So your EBITDA stands for earnings before interest, tax, depreciation, and amortization. So let me give you an example. So let's say your normalized EBITDA profit is around 600K. So normalized is without your cost, right? So your cost shouldn't be in this EBITDA number. And let's say you could sell your business for a multiple of 4.5. So you've got a sales price of 4.5 times 600,000, which is 2.7 million pounds. Now that is on a cash-free, debt-free basis. So any adjustments to your working capital, either positives or negatives, are adjusted for that, and any debt that you've got has got to be paid off, and the rest is yours. So that's that's how we work out our valuation of a company. So let's do the same example that we did before on the build to hold on a build to sell and see what that means. So we'll keep the same passive income target of £150,000 before tax. So this is now going to come from income from investment. So we're going to sell our company for a lump sum. We're going to put that in investments, and those investments are going to yield us our £150,000. So clearly, because we've sold the company, we don't have anything to worry about because this is all 100% passive. So let's say we could invest money, and let's be conservative and say that we can get a yield on those investments of 5%, which means that we're going to have to invest 150,000 divided by 5%, £3 million. So if we can invest £3 million in paper investments, property investments, pension investments, that's going to yield us £150,000 a year. So we need to get to £3 million. But we're going to have to pay, if we sell our company, we're going to have to pay some tax. Now, on this basis, I'm going to just assume the entrepreneur's tax to make it easy numbers. So our sales price before tax is going to have to be 3.3 million, because obviously I'm investing money after tax. So now I've got to sell my business for at least 3.3 million in order to invest my 3 million. And let's say the EBITDA multiple I could get for my business type was a multiple of 4. So the sale price is going to be 4 times my normalized EBITDA. So in that case, I'm going to need an EBITDA of 3.3 million divided by 4. So I'm going to need an annualized EBITDA of £825,000 a year. And assuming my EBITDA profit ratio is 22%, just an example, then the sales required to build a business of that shape is going to be 825,000 divided by 22%, 3.75 million. So this, now we have clarity. So if we can build a business with a sales of 3.75 million and an EBITDA profit ratio of 22% and sell it for a multiple of 4 times EBITDA, then we're going to be able to invest £3 million in our personal investments, which will give us £150,000 a year, and I don't even have to get out of bed if I don't want to. So that's an example of building to sell. Now, it's really important on each one of these strategies to set clear targets, because our experience as business owners is when you set clear targets, and most of our clients, when they set clear targets, we meet them because it's clear what we need to get to. Whereas if you just go from year to year and iterate, again, you're flying the plane without any controls and without any destination. So I'd encourage you to set clear targets. Now, one other thing I wanted to cover is the concept of leverage, because if you're building a business to sell, leverage is important. Now, the concepts of leverage is you use other people's money to accelerate the growth of your business. Now, again, a lot of business owners have an aversion to debt, but if you're building to sell, debt is good, and I'll try and explain why. So let's take example 1, where you decide just to build from your own cash flow. So you don't want to take any debt, you're just going to build from your own cash flow. So let's say you're planning next year, let's say you're doing £1 million sales at the moment, and you're going to plan to do 1.2, 20% sales growth. So your EBITDA goes from 220,000 on a 22% EBITDA ratio to 264,000. Our EBITDA multiple actually doesn't change much because it's a medium growth business. So in order for the multiple to change, the business has got to be more exciting, has got to have better quality revenue, and has got to be faster growing. Okay, so the multiple in this case hasn't changed. So our sale price now is going to be around £1 million, 4 times the 264. Now let's say we take a more leveraged position and go out and say, look, I can accelerate my marketing if I borrow £100,000. So borrow £100,000, put it into marketing, and put it into a marketing director or marketing team, accelerate the side of the pace of my growth. So in this case, the growth goes from, well, I go from £1 million to £1.5 million. And my EBITDA goes from 220 to 330. And because I'm now categorized as a high growth business, my multiple goes from 4 to 5. I get a better multiple because it's a more exciting business. So now I have a 5 times 330 EBITDA multiple. So my sale price now is 1.65 million pounds. So it's gone up by 0.65 a million, 650,000 pounds. Now, obviously, I have to pay back my debt, but I still got a valuation of 1.55 million pounds vis-a-vis the 1 million pound, just by borrowing 100,000 pounds and paying it back when I sell the business. So that's an example of leveraging other people's money to increase the value of your business. So if you are building to sell, I would encourage you, if you don't like debt, to fall in love with debt. Obviously, equity investment is the other option. I've used this example as debt, but you can take money as equity as well as debt. But this is a good way to grow the speed of growth of your business. Okay, so I've talked a lot. So I'm just going to hold there and ask you a question. So ask you the question, do you have a clear financial strategy? If so, have you set clear financial goals for that strategy? And thirdly, are you on track to achieve them? So I'm just going to stop sharing my screen and we'll share that.
So if you want to write your own notes, or if you want to share, if someone wants to share, like unmute yourselves, or if you want to put it in the chat box. This stuff only really kind of comes to life when you actually look at it in your own business and in your own mind. Anyone want to share? Who's got a really clear financial strategy?
Yep. Well, we have. I've got Ballaway, DevComs. We know where we want to, what we want to achieve after 3 years. So we know what our annual sales are that we want to achieve, and we've got a detailed budget for the next year, month on month, in terms of sales and also profit and loss as well. So far, okay, our financial year only starts on the 1st of April. 3 weeks in, we're on track.
Fantastic. Thanks, Rob. I would hope so too, by the way, but anybody that's just thinking about what their financial strategy should be. So anyone who's kind of wondering what the best direction is for the business, that would be a good share.
Yeah, that'd be great.
Hi, my name's Tom. I've just set up my business, so very, very early days. I do have a sort of financial strategy. I have a clear financial budget, i.e. what I would like to achieve, what we need to achieve. And it's too early for me to say, have we achieved them yet? But this has all been very, very interesting for myself.
Fantastic.
Yeah, the important thing, Tom, and hi, Tom, nice to meet you. The important thing is that when you have the end game in mind on a financial strategy basis, you can just track where you're going, and every week, Rob, I hope you're looking at your finances every week, that every week you can really work out what you need to do every day, really, to kind of push you on to hit the goals that you need that quarter. So although you're just starting up, make sure you keep your eye on the detail, the numbers, and see what you need to change and tweak as you move along.
Absolutely. I have a spreadsheet that's always open on my computer that I look at about 50 times a day, and it's like I've never done this before, so it's what I think a P&L forecast, cash flow should look like, moving into the next 6 to 12 months. And I'm always tweaking things, right? Okay, we need to earn this much this month to get this net. But watching this made me realize the terminology, like cash flow forecast versus net profits before and after tax, that kind of thing. So it's I'm obsessed about the spreadsheet.
That's good. Stay obsessed, because people fall down when they get to established stage and they take their eye off the ball. So stay obsessed. Anyone else who doesn't have a clear strategy?
Yeah, much the same as Tom. I've just launched my business a matter of weeks ago, and spent a long time doing the financial planning for it. But inevitably, because we're super early stage, so we're still in kind of proof of concept, really. whilst we've got these long-term goals, which are pretty fixed and certain, in the short term, it's extremely volatile and plans change every single day, you know. So it's sort of, whilst I've got this kind of watertight plan, what I'm trying to work out at the moment is a good method just to work out where the flex lies in the various parts of that plan, like just broadly speaking on our overheads and what our sales target should be realistically. And of course, the other major part being funding injections, which are sort of small and more regular at the moment.
Great. That's a great setup for my next bit, actually. So should we crack on then, Joe, and have a look? What I want to have a look at now is, once you've got your financial plan and you've built a strategy and you know what your goals are, is what's the best and easiest way to make profit? Because I can tell you there are hard ways to make money and there are easy ways to make money. And I'm guessing, looking at all of you here this morning, you'd much prefer the easy ways than the hard ways, right? So the model I'm going to show you is a model that helps you focus on the easy ways to make money. So I'm going to share my screen again and show you that. Okay. So now most of you will know in your business the obvious numbers. So you will know how many customers you've got, what's your sales revenue, and also what your net profit is. Okay, so you know those, and nearly every business owner I speak to know those numbers. However, I have to say those numbers are pretty useless because those are just outcomes. What you really need to control, or only things we can control, are the drivers behind them. So the drivers behind the number of customers we've got are our leads coming into the business times our conversion rate. And the drivers behind our revenue are our customers times the average spend of a customer times the amount of times that customer buys from you, the frequency. So the number of customers times the average spend times the frequency of purchase gives us our revenue. And the revenue times our percentage profit margin makes our net profit. Now those 5 things, leads, conversion, average spend, frequency, and margin, are the only things that are going to make you more profit. And every business we've ever looked at, that is true. So let me give you an example. So let's make it a month. So let's say you get 10 leads in the month and you can convert at 50%. So you've got 5 customers. And let's say that every one of those customers, every time they buy from you, they spend £400. And let's say they buy from you on average 3 times a month, which gives you a monthly revenue of £6,000. And let's say your profit margin on that is 50%. So maybe you're a consultancy business or something like that. So we have a net profit of £3,000. Now, what the interesting bit here is what happens if, let's say, every 90 days, you look at your lead number and you ask yourself one simple question, and that's say, what can I do this quarter to increase my leads just by a small amount? And you do the same with conversion, average spend, frequency, and margin. Now, if you increased each one of those by 10%, what do you think will happen to your number at the bottom? So I know some of you now trying to guess it or quickly do maths, but let's show you what actually happens because it's quite surprising. So let's just do the numbers. So let's say we worked on your marketing systems a little bit maybe increased the intensity of our PPC or SEO or something like that, and took our leads in the next 90 days up by 10%. So we got 11 leads coming in rather than 10. And let's say we worked a little bit on our telephone scripts to make sure we were better at converting. And our conversion rate went up again, just 10% to 55%. Now we've got 6.05 customers. Then we did the same, take the same approach with average spend and frequency. So on the average spend side, we upsold, let's say we did a strategy to upsell more of our customers onto a slightly more expensive product or another product layer. So through that effort, on average, our average spend goes up by just 10% to 440. And let's say on a frequency side, we sent out a newsletter to all our existing customers, and that increased our average spend, our average frequency of purchase just by 10% to 3.3. So now our revenue is our 6.05 customers times 440 times 3.3 equals a revenue now of 8785. Just by making 4 changes to things that are totally in our control, and those small changes were really easy to do. It was just focus. And let's say we did the same with our margin. We maybe looked at our pricing or looked at our import costs just to tweak our percentage margin up by just 10% to 55. So 55% of 8785 now gives us a net profit of 4832. So 5 small changes have given us a 61% increase in our net profit. So guys, business does not have to be complicated. Because if you focus every 90 days on things that just drive the 5 key drivers, your business will continue to grow profitably. Now, clearly you need to know your numbers to start with. So you need to understand your leads and conversion. You need to understand your average spend and frequency, and you need to understand your margin. But assuming you have all the tools in place that we've just been talking about, these things will be at the tip of your tongue because you really understand those numbers, and you have to understand them to start with before you can make improvements of them, because obviously we're going to experiment, see what works, see what happens to the number every 90 days. So some proposed action steps for you. So first of all, make sure you've got your key financial tools in place and use them, because there's no point if your accountant's maybe doing all of this stuff and you're not looking at them or reading them or using them to make objective decisions. Secondly, plan your personal financial strategy and set hard financial goals for yourself, because I guarantee you, if you set yourself financial goals, you will meet them. You will meet them. If you get the right people and help around you, you will meet your financial goals. If you don't set financial goals, who knows what you're going to end up. Thirdly, understand your 5 ways base point. Okay, where are we today on leads, on conversion, on average spend, on frequency, and percentage profit? And then put your 90-day strategies in place to drive each one of those levers to start driving increased profits through your business. So those are my proposed action steps. Now, before I leave you today, I wanted to show you a piece of software that we're using with our customers today, our clients today, which actually make all this quite easy. Because one of the problems I think business owners have is, you know, all the data's in different place. You've got some stuff over here on Xero, you've got some stuff over here on an Excel sheet, and actually it's very hard to see a clear picture and see how all this data interacts with itself. So I'm going to attempt to give you a demonstration of some software we use that might help you. So just bear with me a moment. Right, so this is the software and it's called Action Cash or Cash Flow Story. So let me give you an example of how this works. So let's take an example here. This is a fictional company, so Blue Consulting Group. So the first thing we do is we just load up from your accounting system the basic numbers. So we take from 0, or we can take it from any of your accounting packages really, and just import your key numbers. We can either do that with an Excel sheet, or you can just put them straight in. Now, once the system has got those numbers, and really we need about 3 years. If you're a newer business, we can do it by quarter and put like consecutive quarters in. But in an ideal world, 3 years data is really good. And then what we can do is lots of things. So I don't want to show you everything this morning, but I'll show you some of the bits that I like the most anyway. So the first bit, if you go to the summary, it gives you a clear graphical interpretation of what we've just been talking about. So it tells you your profit story, what your business looks like from a profitability perspective. It tells you your balance sheet story. What does it look like from an equity, assets, and liabilities perspective? So you can see that super clearly. And it also tells you your cash flow story. What's happening to the cash in your business? So first of all, you as a business owner, and I don't know whether you, but I'm much better with graphical stuff than loads of numbers. It shows me exactly what's happening in my business. But the exciting bit actually is this, which is an inbuilt 5 ways calculator. So basically what this does is says, well, what happens if I change something in my business? So at the moment, all this is set to 1%. Okay, so everything is now set to 1% increase. And your base numbers here on the top. So the cash flow of this business is a -1 and an operating profit of 6.25 million. It's quite a big business. So you can ask yourself the question, have a play with the what ifs. So you can say, okay, what happens if I take my volume up by 10%? So the volume of transactions coming through my business up by 10%. So what you can see here, you have a positive increase on cash flow and a positive increase on profit. So my profit has now gone to 8.8 million and my cash flow has improved, but it's still negative. Because obviously there's quite a lot of cost of sales and working capital involved with volume, with new transactions coming through the business. So then you say, well, okay, is there an easier way to do this? Is there a better way that we could focus our efforts that has an even better effect than that? So I'm going to take that back down to 1 and go, what happens if I increase my prices by 10%? What happens then? Wow, that has a massively different effect. So our cash flow goes up by 2.6 million and our profit goes up by 3.5 million. So now we've got a profit of over 10 million pounds and we've got a positive cash flow. So what we can say on this business is that that particular lever has a much greater impact than the other lever. And obviously you can do all of these strategical changes to say, okay, what's the best thing to do with my business in order to make it the most valuable? And the last bit I'm going to show you is the fun bit, which says, what does this do to the value of my business? So here the value is currently set at a multiple of 5 times earnings and is valued at 24 million at 5 times EBITDA. But the 10% increase on price that I've just done, the power of 1 impact, or our 5 ways impacts, adds another 21 million pounds worth of value. So now I've got a business value of 45 million pounds. And I've set myself a target of £50 million. So I've only got another £4 million to do. So I'm going to go back to my power of one and say, okay, how do I get my other 4 million? And it also allows you to, change things, like say, well, okay, if I don't think I can get a 5 multiple, but I think I can get a 4 multiple, you can just refresh that and see what the impact is down here. So if I just get a 4 multiple, my improved business value is £35 million. I've still got 14 million pounds to go. So what you can see, this is a really easy way to plan and strategize with your real numbers, with your real business, and decide how to do the cash flow. Now, if this is something that's interesting to you, we're more than happy to spend time with you and put these figures for your business into the software and work with you to show how you can make an improvements. So if you're interested in doing that, please contact us. We won't charge you for the first bit, but obviously if you want to go and own the software, then obviously there will be a small charge, but I can guarantee you that the improvements in the value of your business will be significantly bigger than what it cost you on the software side. So now I'm going to stop sharing now, and basically I'm going to throw it open for any questions you've got on anything you've heard this morning. So shoot if anyone's got any questions. I know there's a lot of numbers this morning, and hopefully you are keeping up with a calculator and the pad. I can't believe there's no questions.
I'll be brave.
Oh, well done, Helena.
Shoot.
Sorry that it's me. We don't have a financial strategy, as you well know. But I'm one step closer. I suppose for us, we're not a new business, and if I organise myself better, we've probably got quite a lot of information to draw on, although quite a lot of it is a bit chaotic. We make furniture. My husband makes furniture. We have a small team. I suppose for all those numbers, it's probably quite taxing for me to come up with numbers that are really accurate. So my question, I suppose, is if you're starting with numbers that are as close as, but you're not quite sure, do you err on the side of optimism so that it's more motivating, or do you err on the side of caution so that you've got more chance of feeling like a win? Because I don't believe for 1 minute that the numbers ever say what you think they're going to say.
Great question, Helena. And I guess the answer is depends who you're talking to. If you're talking to the tax man, you do one thing. If you're talking to yourself, you do another thing. But in principle, yeah, depending where you start, yeah, it's not important to be 100% perfect or have all of this now. Yeah, the most important thing is you are getting closer to that every month, right? Yeah. So if you're working with numbers, you get familiar with numbers and you get comfortable with numbers. Yeah. So what I'd encourage you to do is just start with, let's say, the P&L. Start getting the P&L in order every month. And once you're confident with the P&L, then go and make a budget and then a forecast. And once you're confident about that, then go to the cash flow forecast. Okay. So if it takes you 18 months, to get all this in place, don't worry about that. Don't worry about that. Do it at your own pace, because providing we get there at some point, that's fine. A lot of business owners that we see every day, they kind of never get there. So don't be afraid of doing it in gradual steps, and don't look for perfection. It doesn't have to be perfect. I'd much rather you were working the numbers and getting comfortable with them and them being only 85% right than not doing it at all.
Okay. I still don't believe in the perfection. I've yet to find it.
Fantastic. Thanks, Helena. Any other questions, guys?
I've got a question for you guys then. Who's measuring their 5 ways? Who's measuring those 5 things that David went through as part of their quarterly plan every month? Who's setting themselves a goal and saying, okay, this quarter, I'm going to up my rate of conversion from 50% to 60%?
I can see Rachel nodding shaking her head saying no.
It's just a very good idea if you are doing quarterly plans or you're new to quarterly plans, is to make sure you bring one of those into it, because they're going to affect your bottom line. So just start to think about, what could I improve on those 5 ways to drive profits, and where's there a skill gap? Do I even know my conversion rate? Who knows their conversion rate? Who doesn't count lots of people they talk to that they didn't convert, and that doesn't come into it? Yeah, what am I doing? What am I not doing? Do I need to get better at sales? Because one of the things as a business owner is that we take on everything and we forget that we need training and development. Yeah, so could I get better at sales? Could I get better at marketing? What do I need to do differently to bring in more leads, to convert more leads? So just some good food for thought for you all.
What are your thoughts, guys, about that piece of software I showed you? How many people think that might be useful? Susan, yes. Anna, yes. Jamie, yes. Rob, yes. Okay.
David, is that your software?
It belongs to Action Coach, and we pay a license fee for it, and Action Coach pay a license fee to the developers of it. So you can buy it yourself, and the name of it is called Cash Flow Story. But it has been modified for us in order to capture the 5 ways properly. So again, if you want to load up your economics for your business, then contact myself, Chris, or Joe. We'll send you an input sheet so that you can put your numbers into an Excel sheet. We can then input it into the system, and then we can go through it with you. So
does it import from Xero automatically?
It doesn't, no. You have to just transfer your numbers from Xero into an Excel spreadsheet.
Okay.
It doesn't take long. I did it for my own business about 4 months ago, and it literally took me half an hour to set it up for my own business. So it wasn't really hard. And funny, I did make some changes to my own business once I'd locked and loaded it. And I did know my conversion rate, and it wasn't bad.
And roughly, is there a monthly subscription fee?
There is if you use it, yes. So, but it's not very high. It's less than, I think it's about £30 or £40 a month. It's really not expensive.
Okay.
So it's not.
Thank you.
Hi, David. I've got a question to ask. Firstly, your presentation was very insightful, so thank you. The question that I've got to ask is, you talked about financial strategy, and I guess the reason as to why people get into business, whether that's to be their own boss or to build an asset yielding passive income. I think I first started out setting up my business 7 months ago, and that was, yes, because I wanted to be my own boss, but also, to build an asset to provide me with a passive income. And one of the things that you said sort of set off a bit of a light bulb in my head, and that was, to build a business with a passive income, you need to be able to build a team around you that can help you do that, so you're not directly involved of the day-to-day running of that business, which is something I'm very much involved with at the minute. I don't know if you'll be able to answer this, but in terms of putting that team together, at which point, should I be thinking about building a team and expanding? How much money should there be in the bank before I start considering this, for a relatively new business?
It's a great question, but a difficult one to answer. I think most startup businesses go through a number of phases. The first phase is generating enough cash flow and understanding how the business model works. Yeah. So once you start getting customers and they're paying you and they're liking the model, then you can scale it up a little bit to make sure that, first of all, it gives you an income. So the first bit is build a business to give you an income, and so you've got proper cash flow. The next bit is to sit back and then plan it, because then you've got some data to plan it. And you can say, okay, so I can see what the average spend is per customer, what my marketing looks like, and then you can plan 2 things. First of all, where you need to get to with the calculation we did, and then you can start planning, well, what would the team have to look like for that to be true? And you might say, well, I need 1 head here and 3 heads here and 1 person on sales. And then you can build both a team plan and a revenue plan, and then a route to get from where you are today and there. So we often do what we call 1-3-5 plans. So what does the business have to look like in 5 years? What does it have to look like in 3 years? And then 1 year. And then we then do 90-day plans to get there. So our planning process is really what gets you there. But the first bit is just getting out in the marketplace, get some customers, get some revenue, start to understand what's happening in terms of dynamics of the business, and get yourself up to a stage where you can pay yourself.
Yeah, thank you.
Cool. Any other questions, guys? Who's considered borrowing money to leverage their business? Expanding your rate of growth through taking on debt or a shareholder in your business. Anyone consider that? Rob? So what have you thought about in terms of that?
Well, we were given the opportunity of a coronavirus loan, which obviously had very low interest rates, and as well as we haven't had to use it because of the pandemic, but we've got it in place partly as a safety guard during the pandemic, but actually it will provide us with great facility to speed up the growth of the business.
Absolutely. And you're probably paying around 2.5% on interest.
Yeah.
So most business owners, if worth our salt, we should be able to invest money in our own business and get significantly more than 2.5%, right? So you could probably get 50% return on money that you deploy in your own business. So therefore you're borrowing money and paying 2.5% on it, and you're using it to work for you and getting 50% on it, right? So that is a no-brainer. And I know a lot of you got Sybil's loans. I would encourage you not to pay them back. I encourage you to deploy them in your own business and back yourself to get yourself a good return on that money. Cool.
Oh, you got it. We're bang on 10:30.
Great. Hey guys, I hope that was useful. Great to see everybody. Have an amazing weekend. We're back on the 14th of May with the next session, which is customer mastery. So put that in your diary. For 14th of May, we'll be talking about how to make all your customers into raving fans of your business and what that means to you from a financial perspective in your business. So thank you, Joe. Thank you, Chris. Thank you, Philippa and Isabel, for helping us out, and have an amazing weekend. Bye all.